So in this session, we're going to cover why you might want to form a PCN company in the first place. We're going to look in some more detail at what that involves, what the process involves, and we're going to look at some of the things that you should really be considering if you want to incorporate a company for your PCN from both a legal perspective and from a financial perspective. And Katie from Ramsey Brown will be talking about the financial aspects. As I said, we're going to have a Q&A session at the end, and but we can also take questions and comments throughout. So firstly, why would you want to form a PCN company at all? Well, to answer that question, it's important to look at some of the key features of a PCN and what the default position is if you don't have a company for your PCN. And the key point about them is that they're not legal entities in their own right. You have individual practices who sign up to the network contract direct enhanced service and agree to vary their GMS, PMS or APMS contract to incorporate the DES obligations. And a condition of signing up to that DES is that you become a member of a PCN, and you're then collectively responsible with the other practices in the PCN for delivering the DES obligations. So a PCN is a collaborative arrangement without any fixed governance structure. It's just this unincorporated network of practices. And that creates various challenges for PCNs. So relationships is one of the challenges, or it can be. Some PCNs have functioned very well and the practices get on really well, but in others the relationships have been quite challenging, particularly where practices have been put together rather than coming together voluntarily. The employment of workforce is challenging, particularly as PCNs are unincorporated networks and they therefore can't employ the staff in their own right. So any staff have to be employed by the practices within the PCN or by third parties on the PCN's behalf. And I'm going to look at that point in particular in the next slide. Risk and liability is an issue for PCNs. Practices are reliant on other practices within the PCN to help them to deliver their own obligations under the DES, and practices are directly exposed to the network's liabilities, including employment liabilities. Governance of a network can be challenging. As you'll see a bit later on, there's much more robust statutory governance for corporate entities, which is set out in legislation. But PCNs have to determine their own governance arrangements and set those out in their network agreement schedules. And if those schedules aren't well drafted or out of date, this can result in a messy and unclear governance structure that increases the risk of disputes arising. There have also been challenges around tax and accounting and VAT and pensions access as well, which I haven't actually put on this slide, but should have done. PCN companies can offer solutions for some of those challenges. And Katie's going to be looking at the tax and accounting aspects in particular in the VAT and pensions as well. So just coming back to the unincorporated structure and what that looks like as context for why you might want to form a company. If you don't have a company, you have two main alternatives really. So the one on the left is what's been known as the flat or shared model, where you have P1 is the nominated payee for the network, and then the employment of the workforce, those little people dotted around are employed by the individual practices, and that's allocated between the practices. Sometimes there's actual joint employment by the practices, but more commonly practices share it around. So P2 might employ a clinical pharmacist, P4 might employ a social prescribing link worker, etc. And those staff are shared around the different practices. On the right hand side, we have the lead model where you have P1, the nominated payee usually, who employs all the staff on behalf of the practices in the network. And for both of those models, from a liability perspective, it's not particularly attractive for the practices. because any network liabilities are shared between the practices, and the practices themselves generally operate as unincorporated businesses, usually as partnerships or occasionally as sole practitioners. So the partners or the sole practitioners of the practices effectively have unlimited liability, not only for their own practices activities, but also for the activities of the network. From a workforce perspective, it can be, if you have the shared model, the one on the left, it can be very confusing as to which practice is responsible for the workforce. You could have different policies and procedures applying to network staff depending on which practice employs them. And the lead model alleviates some of those issues, but also exposes the lead practice to greater risk. You might agree to share liabilities that are borne by the lead practice between all the practices within the network, but nonetheless, it's the lead practice that's bearing the brunt of that. So, as I've said, it's really important that the network agreement is clear as to how the practices will agree to share the risk and liability. And the concern is that where your network agreement falls away because it's out of date, or you've been doing things differently, or it's not been well drafted, that those kinds of issues aren't addressed properly. And regardless of whether you have a network agreement or not, you can't get away from the fact that it's the individual practices that are bearing these liabilities. VAT is also a concern. The supply of the staff between the practices could give rise to a VAT liability, and Katie's going to talk about that in a bit more detail. So just in summary, it's with either of the unincorporated models, liability, VAT are all concerns, and this the risk associated with PCN activities increases as the PCNs grow and as the workforce grows. And for that reason, we're seeing lots of PCNs looking at forming companies as a vehicle for employing staff and managing risk. So just to talk very briefly about what we mean by incorporating a PCN company and what we mean by a corporate vehicle. So there are various different types of corporate vehicles, and we're going to outline some of those a bit later on. But the key feature of all of them is that they have a legal personality separate from their members. And this means that they can employ staff, own property, enter contracts, sue and be sued in their own name. And this provides some protection to the members who are largely protected from the corporate vehicle's liabilities. So that's, the main reason why a corporate vehicle is attractive for a PCN. And it's also worth looking at the evolving role of the PCN company. So lots of PCNs have already formed companies, and they've primarily been used initially as an employer of the PCN staff because of the difficulties that I've already mentioned around employing staff using the unincorporated models. They are also providing some back office functions, typically managing finances, doing some of the administration of the PCN, and increasingly starting to also perform clinical services as a subcontractor of the core network practices. We're also now starting, so all of those first three bullet points are related directly to the DES, but we're starting to see PCN companies also being used in different ways as PCNs themselves start to do different activities. So, for example, in some parts of the country, ICBs have been commissioning local enhanced services on a PCN by PCN basis and asking the PCNs to nominate a lead provider where those services are contracted using a different contracting mechanism from the DES. So where ICBs choose to commission those services using the NHS standard contract, then they can appoint a single lead provider within the PCN, and the ICB just contracts with that one provider, and then that provider arranges the provision of services within the PCN by subcontracting with the other PCN practices or with third-party providers. Now, if it's an unincorporated PCN, then of course that lead practice is bearing again the brunt of the risk and the liability on behalf of the PCN. So where a PCN has a limited company, that's a far better vehicle for being the lead provider for those from a risk and liability perspective at least. PCN companies can also act as the interface between practices and other organisations. We're seeing an increasingly complex healthcare system where PCNs are expected and practices are expected to engage with the wider system, work as part of integrated neighbourhood teams, perhaps perform some subcontracted activities from other organisations like from the Federation or a trust. And having a limited company is a good way of streamlining that relationship. We're also seeing PCN companies being used as a rescue vehicle for individual practices within a PCN. Some of you might have seen in the news, and I've mentioned this in our previous webinar about the ICB in Herts and West Essex announcing their intention to award a GMS contract to a PCN company on their patch in order to run one of the practices within that PCN. And then something else that we're starting to see increasingly is where PCNs are working well together, starting to explore the option of perhaps all the practices within the PCN merging. And then a next step from that could well be to then incorporate that merged practice into a company, and you would have a single PCN company that was both acting as the core services provider and acting as the vehicle for the PCN. That's the end of the introduction. I'm now going to hand over to my colleague Helen, who's going to talk about in more detail about the process of incorporating a company.
Alison, and hi everyone. I do know a few of you already, but for those that don't know me, my name's Helen Matthews and I'm a senior associate in the commercial team. And I'll be covering what we mean by incorporation in the PCN context, and also looking at some of the key features of a company limited by shares, which is the most common form of company that we see incorporated. And then finally, just touching on the process for forming a PCN company and some of the sort of key considerations to be thinking about. So what do we mean by incorporation? Incorporation means the process of forming an entity which has separate legal personality. So the company is an organisation which exists in its own right. It has distinct legal personality, which sits separately from its members, as Alison's touched on. So when PCNs talk about incorporation, what we're not doing is converting the structure that you currently have, whereby you have several practices who've come together to deliver the DES. And this is probably one of the main points to note and take away from this session, is that your existing PCN structure will remain in place. But by incorporating, you're creating a separate company which sits alongside the PCN. And the company is owned by its members or its shareholders, who are the core network practices. And because your core network practices aren't entities which are legally capable of holding shares or membership in a company, what happens is each practice would nominate a GP to hold the share on behalf of their core practice. And we would make it very clear within the governance documents of the company that the shares are owned by the practice and that any decisions made using that share are practice decisions rather than decisions of the individual holding that share. Because the company is a separate legal entity, the company itself can do business and enter into contracts in its own name. It can hold property, it can sue and be sued under a contract. So the limited company can employ staff under an employment contract rather than an individual practice having to employ that member of staff, or the PCN having to use a third-party provider. And in some instances, the company can also hold a lease in its own name, so it can provide that property solution for PCNs. So the company is a separate legal person. With all companies, information is recorded by Companies House, and it's publicly available on the Companies House website. It's the director's responsibility to maintain the company's public records, including filing annual accounts and confirmation statements about the company. And the directors also have to notify Companies House of any changes in the ownership structure of the company. So limited companies are, Alison touched on, subject to stricter regulatory requirements than unincorporated forms, such as your existing GP partnerships. So they're subject to the Companies Act, which sets out various rules which apply alongside the Articles of Association, which is the governance document of the company. So the Companies Act is the primary source of company law in the UK. It enables companies to be created and provides a framework for their constitution, and contains various requirements to do with sort of the responsibilities of shareholders and directors. But just a point to bear in mind, there are those kind of higher requirements than your existing unincorporated forms. And just looking at in a bit more detail at the types of corporate vehicle that can be created. So the most common form of company that we see incorporated by both PCNs and kind of ordinary businesses is the company limited by shares. So here the core network practices would hold shares in the company, which would entitle them to vote on company matters and give them certain dividend rights. So if the company generates a surplus, the company can choose to pay a dividend to its shareholders. And one of the reasons why the company limited by shares is so popular is that it's the only company which is capable of holding a GMS contract, which allows the company to potentially rescue a GMS contract from a struggling practice. And we've recently seen an ICB actually award a GMS contract direct to a PCN company. So generally, this is the favoured model. Some other common entities, so we've got the company limited by guarantee, where each member agrees to guarantee a set amount towards the company's liabilities rather than hold shares, which tends to be favoured by kind of not-for-profit organisations and charities, and not so much kind of PCNs for the reasons that we've mentioned. And we're also often asked about LLPs, which are entities similar to the partnership model in the sense that the members continue to be taxed as a partnership, but you still have your separate entity. But generally speaking, company limited by shares is the most common because it is the only company which can hold a GMS contract. And once you've formed your company, some PCNs choose to become a social enterprise. So by being a social enterprise, you're effectively making a public statement within your governance documents that you're set up to benefit a specific community or a purpose, rather than the focus being solely about sort of producing profit for your shareholders. And obviously that social purpose is quite easy to demonstrate within PCNs because you're sort of set up to benefit your patient populations. And we'll also tend to be asked about community interest companies, which are one step further than the social enterprise. So a community interest company is legally required to operate for the benefit of their specific purpose, and they're subject to additional regulation. So they're regulated by the regulator of community interest companies, and are subject to lots of rules regarding how much profit they can choose to pay out as a dividend. They're also subject to something called an asset lock. So any property can't be sold for less than its full market value. It has to be used towards that community purpose. So generally speaking, PCNs that we talk to tend to find the KIC model a little bit too onerous, and that they prefer, if you want to go down that route, by using the social enterprise model instead. So looking at the company limited by shares in more detail. So as we've touched on, the core network practices aren't entities which are capable of holding shares. The shares have to be held by a nominated GP on behalf of their core practice. The shares give each practice voting rights, and a right to participate in any profits that are generated by the company. And ordinarily, I'd say we tend to find that each practice will have equal voting rights, so one voting share each. But you could have voting linked to list size. And something for you to consider would be how you would want to share in profits of the company and in what proportion. So whether each practice should receive a share of profits proportionate to their weighted list size, or maybe you want to allow flexibility to pay dividends in varying amounts. So that's something that we would work through with you if you decided to go down the incorporated route. All companies are required to have directors in addition to shareholders. So directors are responsible for the day-to-day management of the company, and they're subject to several duties under the Companies Act, including the duty to act in the best interests of the company. So unlike the shareholding practices, who can make decisions based on their own practices' interests, the directors, when making decisions as the board, must be acting in the best interest of the company. And what we normally find is that the shareholders will ask the directors to manage the day-to-day running of the company, but would include a set of reserved matters within the Articles of Association to require that any key decisions come back to the shareholders. That's a key thing to sort of consider from the outset. Who would you want sat on that board of directors managing the company on a day-to-day basis? The limited company would be governed by the Articles of Association, which is its constitution. So this document would set out how the shareholders and directors make decisions, and it's essentially the rule book of the company. Your PCN, as we've said, you still have your existing unincorporated PCN, which would continue to be governed by your network agreement. But what we do is try to align the governance arrangements of the network within the Articles of Association. So both the PCN and the company are operating under the same decision-making processes. And as we've mentioned, companies are governed by company laws. There are certain requirements with regards to how the companies make decisions and its processes. For example, the requirement to have both directors and shareholders. And the company is regulated by Companies House. So Companies House require certain documents to be filed on an annual basis, such as the accounts of the company and a confirmation statement. But also, if there are any changes within the company to your directors or your shareholders, for example, then you're required to let Companies House know by filing the appropriate forms. So that was hopefully a useful overview of what a company limited by shares looks like. We're now going to look at how the company can be used by the PCN to support with those DES activities. So on the left-hand side, you have your 4 practices who make up your existing primary care network. And you have your one practice highlighted in red, who's the nominated payee, receiving funding under the DES from the commissioner. And then you have your PCN company on the right-hand side, which would be owned and managed by your PCN practices. And what we tend to find, at least initially, is that the company will be used to provide kind of employment and back office sort of admin support. So we've mentioned already that the company can hold contracts in its own name, so it can hold employment contracts and employ network staff, which means that any employment liabilities then become liabilities of the company. And as Alison touched on, the company has limited liability, unlike the partnership model, which means that if the company as an employer was facing an employment claim, the most that the claimant could recover are the assets of the company, but they can't claim from the individual members who'd be the practices. So the most that a shareholder could be required to contribute to a claim is any amount that's unpaid on their shares. So the shareholders would be allotted shares of up to, say, £1 or a penny, so really nominal amounts. So the limited company model is all about protecting kind of individual partners from being exposed financially. And that tends to be why kind of the main focus, at least initially, is that the company will employ those network staff and take those employment liabilities away from the practices. So if the company is employing network staff, it can then supply those staff to the practices who would, at least initially, remain responsible for the clinical service delivery and the clinical aspects of the DES. So here, the company is supplying that non-clinical support to practices. And then over time, you might decide to increase the functions of the company from simply employing network staff and assisting with those non-clinical elements to eventually asking the company to deliver the entire DES contract as a subcontractor for the core network practices. So one of the key takeaways really is that the functions of the company can grow over time. And this should really be one of the first things that you think about and agree on as a network if you decide to go down the incorporated route, is what will this company do? And this slide sort of sets out a sliding scale of the different options. So the left-hand side is the kind of default PCN structure. So where you have your core network practices holding the core contracts, the PCN is governed by its network agreement and schedules, and you haven't sort of started to use the limited company yet to support you. You then move on to the limited company providing that kind of back office and employment support. And if the company is just providing employment support, then you need your employment contracts in place. You need to consider the employment business regulations, which are certain regulations applicable to companies that just employ staff and then transfer the staff elsewhere, so into practices who then might control what the members of staff are doing. And it's just something to bear in mind really at this stage. They're not particularly onerous regulations, but just something to keep in mind. And then over time, you might then subcontract certain clinical services to the company, which would then trigger your CQC registration, and also the need for commissioner consent to subcontract those clinical elements. And what you decide dictates the documents that are needed. So you'll see from the table that where we're asking the company to do something for the practices, we need to document this within a subcontract. And under the subcontract, the core network practices are saying that they are the contractors of the DES. They are passing responsibility for certain aspects to the company. And so the drafting of the subcontract will largely depend on whether the company is delivering clinical or non-clinical aspects of the DES. So it's something that really needs to be thought of from the outset, as it will dictate the documents that are needed. So just a quick recap of some particular considerations to bear in mind. So as we've said, and we keep sort of reiterating, you first need to decide what the company will do. Under the DES, we do need commissioner consent in order to subcontract both non-clinical and clinical aspects of the DES. So just something to bear in mind that the ICB would need to be told that you're using the limited company in this way. In terms of pensions access, so if the company is employing the ARS roles on behalf of the PCN, there are two routes available now, and the route that you take depends on whether the company is delivering clinical or non-clinical services. So again, that distinction is really important from the outset. If the company is delivering clinical services under the DES, then it would need to apply for your independent provider access. And if these are DES clinical services, which have been subcontracted by the practices to the company, then it would be the NHS England template PCN subcontract, which would be required. But it's worth bearing in mind that if the company is delivering other forms of clinical services, for example, it might be used to deliver a local enhanced service, or it might be delivering services which a trust has subcontracted to the company, then it wouldn't be the DES subcontract that would be needed. It might be a different form of contract, such as the NHS standard contract. And then alternatively, if the company is delivering non-clinical aspects, such as simply employing the ARS roles, then you would also need a subcontract in place, albeit it would reference those non-clinical services. And you would be going down the determination or direction status route. And when you apply for access to the NHS pension, NHS BSA will ask to see a copy of the subcontract that you have in place. And technically, under the regulations, a copy of the subcontract is only really required for that independent provider access. But what we're seeing is NHS BSA are asking to see copies for that non-clinical aspects as well. And then in terms of CQC registration, so it would be required for the company if it's delivering clinical services. So if the responsibility for clinical supervision is the company's responsibility, then you need to be thinking about CQC registration. And if the company is employing staff and supplying the staff into practices who manage the staff day to day, then as we touched on, they might be subject to those employment business regulations. And as we've said, they're not particularly onerous. It's generally things like the company would need to have a written document in place. So you'd have your employment contracts, which would tick that box. So not particularly onerous requirements, but something we would work through with you. If the company will be employing sort of existing ARS roles, then you'd need to consider the requirements under TUPE in terms of consulting with staff, informing them of the transfer to the company. And finally, you just need to be thinking about sort of accounting implications of creating a limited company, which Katie will cover shortly. So before we move on to Katie's section, just want to quickly run through the process for setting up the company. So what will those practical steps look like? So stage one, as we sort of keep emphasising, you have to think about what the company will be used for. So the first stage is identify what you're doing now as a PCN, what you maybe want to do in future, and how you'll deliver it and how the company can support you with that. So you need to have a clear idea of what the function of the company will be within the overall sort of network structure. And as we've said, many PCN companies start, at least in the short term, as an employment vehicle and a vehicle for administering PCN activities. And then in the medium term, it might evolve into performing clinical DES services as a subcontractor. And then long term, it might fulfill other functions, such as becoming a vehicle for core service provision or providing other services which kind of lend themselves to that at scale working. And then stage 2, so once you've agreed that you have this need for a company, you can start the incorporation process. So this involves applying to Companies House to register the company. So you'd need a name for the company, which has to be unique and include the word limited. You need a registered office and at least one sort of subscriber, shareholder and director to set the company up. And there's a very small registration fee that's payable to Companies House. And you then be given your unique company registration number as well. So once the company's set up, which can be done fairly quickly, you can start to work on your detailed sort of share structure, your board structure, and your governance documents. So we would develop kind of bespoke articles of association, so the governance document of the company, and we would update the network schedules to reflect that the company is part of the network, and we would align the governance arrangements across the two. And as we've touched on, each practice will normally appoint a single nominee shareholder to hold shares on behalf of their practice. And that person will often also be the practice's representative on the company board of directors. So they'll often be the same person who represents the practice on the unincorporated PCN board, so your existing core practice representatives. And then just whizzing through, so stage 3 is where you sort of prepare to go live. So you prepare for the company to take on functions from the PCN practices. And we've run through most of these points on the previous slides, but as we've said, you'll need some sort of legal documentation. So you need your subcontract between the practices and the company, and your revised network schedules. You also might need a transfer agreement if the company is taking over any assets or staff from the PCN. And if you currently have any third-party providers delivering services that you want the company to take over, you'd need to review those arrangements and start the process of terminating them. And as we've touched on, you'd need that ICB approval to the subcontracting arrangements. If the company is employing staff, you'd need to apply for pensions access, either as an independent provider or that direction determination status. And similarly, you'd also need to think about TUPE requirements if you're transferring existing staff into the company. If the company is performing clinical services, then again, you need to apply for that CQC registration. You'd also need to think about whether the company needs its own bank account. So it's important to remember that the company is not the PCN. They are two separate things, but I'll let Katie expand on that shortly. And you will also need to ensure that the company has its other registrations, so any sort of insurance that it might need to performance functions. So just a key point is that, you know, just because the PCN practices might have these arrangements, such as their insurance policies, you need to sort of put those in place for the company as well, because it is a separate entity. And then once you've got everything ready, you can kind of go live. So you'd complete your legal documentation, date your subcontract, and the staff would transfer over. And then once you've set up your company, it's just worth bearing in mind there are kind of ongoing considerations. So the company would need to comply with its obligations to file certain information at Companies House as and when specific events arrive. There's also various matters that practices need to consider at practice level, particularly when they operate as partnerships. So each member practice of the PCN should check that their partnership agreement documents the partner's role in representing their practice at meetings of the PCN and as the nominated individual holding shares in the company or as a director of the company. And as a quick guide, we've just listed here some of the provisions relating to PCN membership that we'd expect to see in a GP partnership agreement. So you'd want to set out how you choose amongst you who is going to be that practice representative at company meetings, how the share will be owned. So it will be owned for the benefit of the practice, albeit it will be held by one GP. What kind of notice requirements do they have to give you before they want to sort of give up that share or transfer it to somebody else within the practice? And you also need to be clear on what that representative can do at meetings of the PCN. So what can your representative make decisions on? And we've listed some of the key ones there. And finally, because the practice representative is agreeing to hold shares on behalf of the practice, we'd expect the representative to be reimbursed for any sort of losses that it might incur as a result of holding those shares. So to make it fairer, because they're sort of putting their hand up to agree to hold the shares on behalf of everyone else in the partnership. So we thought we'd probably take some questions now, if there are already, on the commercial aspects before moving to Katie's part of the presentation. So were there any questions at this stage on what we've covered so far? And we'll then do a Q&A at the end of the session as well, and we should have some time. I think there is a hand up. Danielle, you. Hi, Danielle.
I've got I'm a PCN manager from Liverpool, and my question is, so we were looking into going limited, but we're kind of putting it on hold for now, and then we're going to look at it, probably it'll be when the next, 2025, when we get the next thing. We don't know, we might do it next year, but one of my questions was, previously when I was off, they looked into going limited, and they only want to take, so we've got like a lot of ours roles, and some of them are practice based and some of them are network based. So we were asked whether we could just go limited and just carry over the network based ones and not the practice based ones. Now, with my HR background, I thought it'd have to be either all, meaning all our staff would have to go over if you went limited company, and you couldn't select some. Am I right, or can you only part transfer over some of your staff?
Shall I take that one?
Yeah, do you want to jump in?
I think you can. I mean, yeah, I think it's we have done it that way before. I mean, I think one of the reasons why that's wanted sometimes is that people don't necessarily always understand that the PCN company is one that's still under the control of the practices, and you can still arrange it that people's supervision and everything is within the practice where they're working, and they can still be allocated specifically to the practice. So I think sometimes it's that practices worry, if they've got ours roles that are working exclusively in their practice, that if they transfer to the company that somehow they won't be able to use those staff in the same way, but that should still be possible. Equally, though, we have managed processes where those practice-based staff have effectively stayed under the employment of those practices where they're working, and only the ones that are working exclusively with, working across the whole network transfer to the company, or across multiple practices transfer to the company. So I think you can usually work around it, whatever works best for the individual PCN.
Yeah, so do you know when you said sorry, I don't mean to go on, but when you said previously you've done it where the practices obviously employ them and keep them on, and some just go over, to the limited company, does that practice then have to accept liability for those staff members? Because obviously my concern would be if it didn't go that way and nobody did accept liability, then there'd be disparity within the team, and then obviously somebody would be liable if there was ever a grievance or anything like that. So in that case, did the practices agree liability for the ones that they were looking to keep on?
Yeah, and this is the more general point anyway, that you would generally put in you would want to have in your network agreement schedules, where you're doing anything that's outside of the company. You need to agree how risk and liability will be shared between the practices. So as a general rule, what we would say is that regardless of who employs the staff, then if they're shared staff, the practices would share the liability for those staff. So even if there's a lead practice, it wouldn't be fair to expect the lead practice to accept all liability in relation to those shared staff. Yeah. But then you can also, within your network agreement schedules, get a bit more sophisticated with how you apportion risk and liability and say, well, okay, well, if, for example, an individual practice causes a loss by behaving wrongly, for example, if they are guilty of discriminatory conduct and that employee brings a claim, then is it fair that all practices bear that liability, or should that rest with the practice that's at fault? And you could similarly provide in your network agreement schedules that if a practice is only working within a single, if a staff member is only working within a single practice, that practice would bear that liability. So I think in that specific case, yes, you could provide for that in your network agreement schedules, but there's also a general point that in your network agreement schedules, you can be quite descriptive about how you would want to apportion liability in different scenarios.
Okay, that's fine. Yeah, thank you. Thanks.
You're welcome. Are there any other questions before we hand over to Katie? No? Should we move over to Katie then?
Thanks, Alison, and thanks, Helen. My name's Katie Collin. I'm a partner at Ramsey Brown. We're a firm of chartered accountants who focus specifically on healthcare and medical professionals. So I have the exciting thrill today to talk about all the fun stuff like money and tax and all the things that you really want to talk about on a Wednesday afternoon. But I'm going to talk a bit about the funding flows going on from what Helen was talking about and the different models. We of course must touch on VAT, and then we're going to talk about good financial governance. So funding flows. This is really kind of the crucial part of today, and to echo what Helen was saying, I think the most important thing is understanding what the nature of the agreement between the company and the PCN is. This is really, really important, and a lot of PCNs we've seen incorporate and don't necessarily understand that and have to kind of go back to that step and revise that and really think about that. It's important to understand what that nature of agreement is because it affects how you account for things. So depending on the model that you pick and what you're choosing for your company to do will change the numbers in the PCN, and it will change the numbers in the company as well, irrespective of where the money is held. And I think that's the really important thing to kind of get your head around. It's a bit like as a partner, there's a difference between drawings and profit. It's exactly the same thing here. So where the money is held is not necessarily where it's accounted for. And that's the point that I'm trying to make here about in the scenario, all the PCN funds can go through the company. So in a slightly different stage now, previously nominated payee had to be a contract holder. So it was very prescriptive. It had to be a holder of a GMS, PMS or APMS contract to be a nominated payee. And of course, because PCNs aren't a legal entity, you couldn't have a separate bank account. So it had to go into a practice bank account and then be moved to another bank account on behalf of the PCN. Now, only 4.5 years into the DES, we can actually finally pay a separate bank account, which means that you can have a nominated bank account, which could be your company's bank account, to hold the money. But the important thing is even if the company is holding all the money, that doesn't necessarily mean that's how it's accounted for. So if I just go back to Helen's model that she was talking about before in terms of your different options, I've dropped the unincorporated PCN because we're assuming here that we're incorporating and looking at how the money flows. So on the left-hand side, you've got your limited company that's just providing effectively your back office or your employment support. So what happens here is your company will take on contracts, bookkeeping, HR, whatever it might be, staff, incurs those costs. All it will do is recharge those costs to the PCN. So in your accounts, you'll have an expense line, which will be all the expenditure, and you'll have an income line, which will be effectively a management charge, which is charging back to its members for the practices of the PCN. That's something called a cost sharing group arrangement. And what that means is the company is not making a profit. Now, the reason we do that is for VAT, which I'll explain shortly, but that's effectively how the money would flow in terms of accounting for in the limited company. Now, even if that happens, all the money may go into the limited company if it's your nominated payee, but the only money that belongs to the company is actually what it's charging back to the PCN, so the value of those costs, which therefore means technically you should have 2 bank accounts. So you have an office account, effectively is your bank account for your company, and then you have a segregated account, which is the money you're holding on behalf of the PCN. Because bear in mind, all the company's doing is incurring those costs on your behalf. So it's not actually the company's money. You may want to keep it in the company because it's ring-fenced into a limited liability vehicle, but fundamentally, it doesn't belong to the company. It's held on account. So you can have a segregated funds account. Now, there are complications with that because any of you who have incorporated may know that opening 1 bank account is challenging enough and only opening 2. And some of the banks do have a solution around that. So I know Lloyds have this segregated funds account that they've opened that they use specifically for PCNs. But that's something to bear in mind in terms of that process and how you account for things, particularly when you're doing your bookkeeping. In that scenario, you'd have a separate PCN system that would have the bookkeeping for the PCN, and you'd have a separate one for the company. And then you need to record what relates to the company in the company's system. On the other side of the spectrum, if we go to the far right hand side, you've got the full service limited company where the whole DES is effectively subcontracted to the company. That's slightly different. So actually what you'd have there are all the costs that are being incurred as part of delivering the DES. But you'd actually have all the income from the PCN being recorded in the company as well, because essentially all of that is going into the company. You'd still have this cost sharing group arrangement on the non-clinical work, and I'll explain why shortly when we talk about VAT, but you will have a profit potentially sitting in the company on your clinical work. So that's slightly different because all the money that's coming into the company effectively belongs to the company because that's delivering on the DES. So how you record those transactions are slightly different. And of course, the model in the middle is a hybrid of the two where you'd have a combination. So something to bear in mind, and we've seen this before, is you set up your limited company, you sort of get cracking, and then you say, well, what is actually belongs to the company and what belongs to the PCN? And people often say, well, I don't know. And that's why it really comes back to that point that Helen was saying is be really clear about what model you're using and why you're doing this. There are plenty of good reasons for doing it, but you've got to make sure you've got the right one for your PCN and what that structure may be. And that may change over time, exactly as Alison and Helen have alluded to. There might be separate contracts that come your way, things might change. But when you're accounting for things, that's really, really important to understand and to take advice on that. So why does it matter? These are the key things you need to think about. The first is surplus. So when we talk about surplus, we don't ever talk about profit with PCNs, but ultimately we're talking about surplus, but that's really what it is. And of course, there are tax implications for that. Now, an unincorporated PCN isn't a legal entity. It has no mechanism to report the surplus that sits in the PCN to HMRC or for superannuation purposes. Sadly, that doesn't mean that it's not taxable and superannuable. It just means the PCN can't do that. Therefore, the obligation is on the member practices to report that surplus in their accounts to HMRC and on their superannuation certificates, irrespective if that surplus has actually been paid out to the practices or not. So it can be quite punitive as an unincorporated PCN that effectively you're paying tax on income that you haven't technically received yet in terms of cash, and there's potential annual allowance implications for that, tax charge implications for that. So it has quite a big knock-on effect. Now, if you have the surplus in the company, you don't pay tax on that personally. The company pays tax on the surplus. You only pay tax personally when you take the money out of the company as dividends or payments, what that look like. And of course, corporation tax, even though it has gone up to 25%, is still lower than income tax, which generally for most GP partners will be around about 45% this year. So there might be an incentive for you to do that. One thing just to draw your attention to is dividends, which get taken out are after corporation tax. So if you want to return back to practices on surplus to be paid out as dividends, there are tax consequences to that as well, because you pay corporation tax first and then you get taxed on the money when you receive it in. So it's really important to take advice in terms of managing that on a regular basis. Of course, the next consideration is VAT. Part of the reason that a lot of people do this is to get this cost sharing group exemption, which I'm going to explain in a minute, but it basically protects you from VAT, which ordinarily in healthcare is exempt, but for some situations with PCNs is becoming a real problem. and I'll explain why. Finally, the other consideration is the pension access. So Helen's already talked a bit about this, but in terms of pension access, you've got the routes of determination status or independent provider. Previously, that wasn't an option for a separate company to have that, and you've got that now. So if that's really important for you to control your staff and supervise your staff internally, you've got that opportunity to do that now as a separate limited company. So moving on. The three little letters that everyone loves to talk about, VAT. And you may be thinking, why are we even talking about VAT? We've never talked about it at a practice level. Most practices aren't VAT registered unless they're providing certain services like being dispensing, or there might be other reasons. So why are we talking about it? Well, if you earn over £85,000 of taxable income, not profit, income, turnover, you need to register for VAT. So taxable income is effectively anything that's not covered by an exemption. So normally healthcare is covered by an exemption, things like insurances, education. So for example, what we do, we're chartered accountants, we're not covered by exemptions. So when you get our fees, they're plus VAT, which means an extra 20% on all our charges. So if you need to register, you have to charge 20% on all your taxable income. If you're also providing exempt services, but you breach the VAT threshold, you will be partially exempt. And you'll see this with dispensing practices, where some of the work that they do in dispensing is taxable for VAT, but the rest of it is healthcare, and so they're partially exempt, which means you can only recover a percentage of the VAT on your costs. So that is important to understand. Now, why? Now, normally in healthcare, we don't see practices generally being registered for VAT. And the reason for that is because there's an exemption. So this is the techie definition. If you ever get bored and have trouble sleeping, you can read the whole VAT guidance on it. But ultimately, it's exempt if the primary purpose of your service is to protect, maintain, or restore the health of the person concerned, the patient. Now that sounds like, well, that's what we're doing in the DES, right? We're looking after our patients. But the really important line there actually is the primary purpose. And the example I always give is blue badge reports. So a blue badge report, you do a report, say that someone can have a blue badge so they can park anywhere. You think that a blue badge report would be doing exactly that. It's protecting, maintaining and restoring the health of a patient. So it's looking after them. According to HMRC, the purpose of a blue badge report, the primary purpose, is to get a blue badge, which in turn protects, maintains, restores the health of the patient, but is not the primary purpose, and therefore blue badge reports technically are a taxable service. Now, before you all panic and think, oh my gosh, we're doing blue badge reports as a practice, therefore we have to register for VAT, I'm sure it's highly unlikely you're doing £85,000 worth of them. So don't be alarmed, you probably don't need to register for VAT, but it's just to illustrate the point that a lot of services actually might technically be taxable if you breach the threshold. And this is really relevant for PCNs because a lot of the services they're doing are, we use the word ancillary to delivering the DES, but technically would be considered as administrative or not clinical. So things like bookkeeping, HR, training, all those sorts of things where you might have a lead practice model that Alison was talking about earlier, that would give rise potentially to taxable income if that practice is charging back those costs to the PCN members. Now, probably, unless you're doing really great bookkeeping, you're probably not charging £85,000 worth of bookkeeping. But where the traps start to come is things like the network manager, the digital transformation lead, or even just the provision of staff that isn't considered a clinical service. So those things are big numbers that could potentially trip you over the VAT threshold. So I'm just going to give you an example. I've got an unincorporated PCN, very nice PCN, very mature, work very well together. They are using a hybrid model. So they use partly their federation and they also partly have a lead practice model. So the federation employs most of their clinical staff, with the exception of a couple of clinical pharmacists that are employed by the lead practice. The lead practice has the CD as a partner there in their practice. They also employ their network manager and they employ their digital transformation lead. So just to give you an idea, that the CD is paid roughly £67,000 a year, the network manager about 45, and the digital transformation lead is about 75, inclusive of on costs. So they incur those costs and they charge them back to the PCN. Now, if you look at those numbers, even if we just remove the CD for a moment, because there are issues around whether the CD is considered taxable or not for VAT, but we'll park that for a second. The total of those charges just for the network manager and the digital transformation lead is £120,000. And those are not clinical services that you're delivering. Yes, they're in aid of the DES, but they're not technically clinical. So in theory, this practice has a problem because it should be registering for VAT, which would then mean it would need to charge 20% on those charges for the network manager and the digital transformation lead. Now, that VAT is not recoverable from the PCN perspective, or the other option is the lead practice has to just swallow 20% of its turnover and give that over to the taxman. So suddenly, this becomes a very real problem. On top of which, there's a question about whether the clinical director role would be considered as clinical or considered as administrative. I know there are some accountants that feel very passionately that this should be a taxable supply and some that don't. But ultimately, if we take that aside, even then, some of these different roles that are coming in are not clinical and therefore could cause an issue. So that combined with anything else you're doing in the practice might tip you over the VAT threshold. So how does a company help? So I've mentioned this term cost sharing group exemption. This is where a collection of independent group of persons provide services that are exempt effectively. What it is it's a separate entity that is set up that charges members for the cost of the service it provides, and it gives you a VAT exemption. So it has to be a separate entity, and that could be either of those three options. As Helen said, limited company is the one that you would see because LLPs actually can't hold pension access, and partnerships puts you in the same position. But it has to be a separate entity. Its beneficiaries need to be the shareholders of that entity. And the intention is basically that that entity can operate at scale and charge back to its members without incurring costs. So that's the basis of a cost sharing group. An example you might see is your limited company might go out and tender for 6 websites for all its practices. It would get an economy of scale because you probably get a discount for doing 6 websites, and then charges those costs back out to the practices. So the practices get a cheaper rate. There's no VAT incurred. These are just some of the conditions that are required. We'll share the slides after, so very happy to share those details with you. But just to say that this is the conditions, so it has to be supplying services, it has to be a separate entity. All of these a PCN company would fit. One thing I just wanted to point out was point 6 and 7. So it has to be at cost, no profit margin, so the company can't make a markup. And 7, the cost must not create a distortion of competition, i.e. you can't charge it at 1p when it actually costs you £100,000 because that's not competitive. So the idea of cost sharing is you can show what comes in goes out. So what are the practicalities of establishing this? We've already told you all these things you need to do to set up a limited company. Well, actually, really, there aren't any practicalities. You don't have to register with HMRC and tell them you're a cost sharing group. You don't have to fill in any forms. You don't have to write to them. You just have to be able to demonstrate that you're meeting the requirements. And that's the really important part, is you have to have a mechanism to be able to show that you're only charging at cost. And particularly if you're splitting things like clinical and non-clinical services in the models that we were talking about, the funding flows, you'll need to have appropriate books and records that can demonstrate that to HMRC. So that will be really important. The advantages and disadvantages of why would you do this? So the big advantage, of course, is there's no VAT. If you have to charge VAT, you lose 20% of your income. Practices can enjoy the economies of scale. So as you said, we have some PCN companies that have started tendering for contracts on behalf of their practices and getting economy of scale and getting good discounts. Big thing is that you can employ staff, you can reduce the liability without having the VAT. And the other one I just wanted to point out was at the bottom is the company can continue providing exempt supplies to the PCN if it becomes VAT registered in the future. So what you might do is a PCN be really, really successful, and you might have a neighbouring PCN that says, hey, your company's doing really well, can you give us back office supplies? You could give them services and charge them VAT, but as long as you're meeting the cost sharing group exemption within your own PCN, you can ring fence that and not have to charge your own practices any VAT. Of course, nothing's perfect. What are the disadvantages? Well, the disadvantage is the company can't make a profit. So there's a question, I guess, in terms of the viability of the company if it's not being supported by the PCN funding flows. Potentially a likelihood of HMRC inspection if VAT registered. Haven't seen that yet, but I guess it potentially is a risk. I suppose the main thing really is the administrative burden of making sure that you're actually recording things properly and being able to demonstrate that. So that takes us on very nicely into good governance and why that's so important. So what we often see is everyone's very enthusiastic about incorporation. They go and they incorporate, it's brilliant, and they set it all up, and then it kind of gets left. And the post setup is so important in terms of making this work for you and your PCN. So I've put some points here about the things that we need to run through, and I'm just going to talk you through them very quickly. Keeping books and records sounds like a really obvious one, and I'm an accountant, so I'll obviously preach about this all day, but it's so important to do. It's actually a requirement under the Companies Act as directors that you are responsible for maintaining books and records. But again, going back to the point that we've been talking about, understanding what your company's doing and making sure that you know what you're subcontracting and what you're not is really important, and making sure you're recording what relates to the company and what relates to the PCN is absolutely crucial. So we recommend having a separate Xero subscription. We're platinum partners of Xero, so we love it. That I won't sell Xero today, but having a separate system for your own company, making sure that it links into the bank account, so it will pull all the transactions in, reconciling it on a regular basis. And the key thing that we love about Xero is you can track. So making sure you're tracking for your cost sharing group purposes, that you're showing that what's coming in from an administrative perspective is being charged back out. So that is the most important thing. And that really links back into the bottom point about transparency to members. So a lot of the confusion, I think, with PCNs, particularly on the lead model, is that everything feels quite hidden. And it's not because it's actually hidden, it's just extremely convoluted, as you've probably gathered from today. But actually, transparency and governance are the most important things that we can promote to help you work together as a PCN. So by having good books and records, if you have a Xero subscription, you can add in all the PCN members so they can see what's going on in the company. They can see management accounts. They have an audit trail of what's going on. It just promotes a feeling of goodwill that everyone knows what's going on with the money. Whether they're involved in it or not, it's about having that transparency. You can only really do that if you're on top of your finances. A couple of other things just to point out is processing payroll obligations. We've had PCNs who've incorporated and suddenly realised, oh no, we have a payment run in 3 weeks. We've got to pay our staff. Do you guys do payroll? So before, and I'm sure Helen and Alison's team would make sure before you get to that go live stage, you've got that infrastructure set up. But really important, if you are bringing staff into the business, you've got to make sure they get paid. You've got to make sure that you're taking on those obligations as a company. And of course, the pension application is going to be crucial in terms of compliance, and that will be the company's responsibility to make sure it's complying. Cash flow management is a big one, particularly for those PCNs who are incorporating, moving away from federation. So federations often have quite good cash reserves, which they've built up over time. A newly incorporated PCN company will not have any cash in the bank account. And of course, ARRS runs 2 to 3 months in arrears. So thinking about how are you going to pay your staff? How are you going to meet the expenses? How are you going to manage that? There's two sort of ways you can set that up. You can either have a loan to the company from the PCN, which is debt, or a capital buy-in, which is equity. I have to be honest, I've never seen the latter. I've only ever seen the former. And it's really important, again, to take good accounting advice on how to structure that. But making sure there's cash in the company is absolutely crucial, and managing that cash flow. As you know, in primary care, that's the big issue. Pay runs and payment authorizations. So again, company has different policies and procedures that it has to comply with. So you have the ability to start to set up these systems now that you're setting up a new company, how a document's approved, who's approving them, how the payment run's happening on a monthly basis, who's approving the invoices, making sure that system is in place. So really good governance. And again, that's something, you know, we can help with, or your accountants can help with. So I'm very quickly going to touch on pensions because I'm conscious of time. I know Helen's already talked about pensions, but this is an area that a lot of people fall into a stumbling block in. I'm going to talk mostly about determination status, because that's kind of the key one that I think we see a lot of issues with. But it's really important to consider how you're bringing employees into the company if you're bringing employees into the company. So if you're tubing them, you have a closed application, which means it's specific to those employees. So those individuals have to be named and their pension records have to be transferred over. If you want to take on new employees, it's open status that you need. But the application can only happen after the company's incorporated and gets backdated. So what you have to do while you're waiting for the application, if you're already paying staff, is effectively hold back their pension wait till you get the pension status and then pay the backdated pensions. So again, from cash flow, quite important to think about in terms of the books and records, how you're recording that. You need to be able to provide a standard NHS subcontract to go to NHS pensions. They will then write to each member practice. So again, teeing up your practices to make sure that they respond to that quickly. We've seen a lot of issues where that's been stretched out because people didn't know they needed to reply. Once that happens, then it goes to the Department of Health and Social Care. I mean, this can take up to 3 months or longer to do. So just consider the pension regulations, particularly as an employer. So you'll have deadlines that you'll need to file things by, particularly if you need to provide an EA code. So you need to do that application, or you'll need to be speaking to the pensions regulator as much as possible. The other point just to point out is that historical issues can come to light, particularly when you're tutoring staff. So you might have people who should have been given pensions access in their previous employer and weren't, or people who don't have access to their pension records. So again, these are just issues you'll need to work through and make sure that you've got set up. So very, very quickly, I just wanted to run through, after all of this and everything we've talked about, what are the advantages and disadvantages of incorporating? So hopefully you've realised the main advantage, of course, more than anything, is the limited liability. So at the moment, as general partnerships, you've got unlimited liability. You're jointly and severally liable as partners. And of course, as an unincorporated PCN, you have no protection, really. So that's the main reason that people do that. And particularly there was anxiety around redundancy and what would happen at the end of the DES. That would all be protected if it's through the company. One thing to point out, and I know this kind of links into the question that we had before about moving staff over, is one of the benefits is giving a single employer. So sometimes what we see is if you have different staff employed by different practices, but they're all our staff rather than practice staff, is they're all under different terms and conditions. One practice may have 5 weeks of annual leave, one practice may have 4, one practice may uplift their staff by X or differently, or have sick days. So by having one combined employer, you've got continuity across all your employees, including employment for the CED as well, because there's potentially risk around personal tax issues with the CED. I won't worry too much about pension scheme accessibility. That's just to say that you have that now. We've talked a bit about corporation tax and VAT. But the final 4 points, I think, are also sort of added value. So the thing with a limited company is you can actually separate out who your owners and who your managers are and what you want your management structure to be. And if you actually remember what PCNs were supposed to be, they were supposed to be a wide environment. So you were supposed to have core network practices and non-core members. And actually with an incorporated vehicle, you could start to look at how you could manage that. You can bring in people like CEOs or COOs into your team, but not necessarily make them a director and give them a board vote. So you can play with the management structure, and actually all of that promotes good governance and transparency, and that's really what it's all about. The final point I also just wanted to raise was the ability to hold contracts. So as Alison mentioned, there is a PCN now that holds a GMS contract, and we're starting to see that a lot more, certainly in North West London. They've issued now locally commissioned services to PCNs, so just potentially future proofing. Nothing in life is perfect, sadly. So there are some disadvantages. As directors, you have fiduciary duties that are governed by law. At the moment, you don't really have anything. You're just unincorporated, so you don't really have to do anything. Obviously, that's not good governance. And for tax implications, there are, of course, reasons why you would want to have accounts and so on and so forth. But you're not bound by it. Once you become a company, you have to have, accounts. You have to do a CT 600. You have costs of running that, and you have obligations as directors as well. Your information also gets published at Companies House. For those of you who've ever seen a small company set of accounts, it's really hard to see anything in it, but nevertheless, there is information out there in the public about your PCN. So that's just something to be mindful of. There are also, of course, costs to doing all of this. I would love to say we do it for free, but sadly that's not true. But there are costs to running a company, having annual accounts, having to do the filings. Obviously, all those sorts of things just need to be taken into account as well. And finally, some of the points that Helen already alluded to, CQC registration, TUPE, all of those sorts of things. There is a question about whether companies are less flexible than general partnerships. So obviously they're more protective, but with that comes complications in terms of, let's say, if someone wanted to exit the company, you have statutory route that you have to take. So slightly more regimented in terms of how you manage that. And of course, the question is around what is the NHS vision overall. So those are all the advantages, disadvantages. I'm very sorry, we've got a very short amount of time for questions and discussion.
We've got 1 minute.
But I'm happy to go on a bit longer, but I don't know if anybody had any questions. Feel free to put your hands up and we can take your view and take your camera. Does anyone have any questions? If you feel more comfortable, very welcome to put anything into the chat as well.
Yeah, and I think we'll circulate the slides afterwards, and that our contact details will be on that as well. So please do email if you have questions. I'm not making any promises on Katie's behalf, but Helen and I, you're free to book as an attendee at this webinar. If you've got questions and you'd like to have a 30-minute session with any follow-up questions, please contact us before the 31st of January, and we'll do that. But actually, even after the 31st of January, we're always happy to take questions. So just get in touch. We've got some upcoming events. One of the things you might be interested in is that in January, we're doing a session on NHS pensions with some contacts of ours, Jill Rogers and Jan Harley Doyles, who've done some consultancy work with practices, identifying where the pension scheme isn't administered correctly, and some of the issues that can arise around that. So if that's of interest, please look out for details and sign up for that. And then we have an event in February with BW Medical Accountants and Shanaz Stansfield on what makes a great practice, and then something on PCN organisational development in March. So we've got lots coming up soon. If there are no questions, I'll just say thank you very much to Katie and Helen for their input. And there is in the chat a feedback survey, so if you would please give us your feedback, we'd very much appreciate that. And thank you everyone for coming.